called him out, right, on his public platform as president of the United States. This is called fractional reserve banking. If you're wondering why stablecoins even matter, hang on, I'm going to get to that in a second, because that's really at the heart of this entire fight.
Today, we are breaking down Mark Moss's definitive 2026 roadmap. We'll explore the secret Section 404 that the banks are spending millions to kill, the moment Kraken broke the banking monopoly by gaining direct access to the Fed, and why we are currently in a small, historic window to build generational wealth. If you're still holding your life savings in a traditional bank account, you are on the wrong side of history. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Now, one of his stated priorities was making the U.S. the crypto capital of the world. Now, he actually started delivering on that, right? So earlier this year, we saw Congress pass what's called the Genius Act, and that was a really big deal. It was the first federal regulatory framework for stablecoins that was ever passed in the United States. It was the first time there were clear rules around what a stablecoin is, how they should work, and more importantly, who can issue one. Now, if you're wondering why stablecoins even matter, hang on, I'm going to get to that in a second, because that's really at the heart of this entire fight. Now, the Genius Act was just the first step, right? It was the first piece, but the next piece of legislation is what's called the Clarity Act, all right? And this is where it gets even bigger, because the Clarity Act passed already through the House. It's now sitting in the Senate Banking Committee, and if it's passed, it creates clear regulatory framework for the entire digital asset market, which I know it sounds boring, I get that. But buried inside this bill is one specific provision. It's Section 404, all right? Now, Section 404 is what the mainstream press are completely missing. Maybe they're completely ignoring, but it's the reason that the banks are spending tens of millions of dollars to make sure this bill never sees the Senate vote. Now, President Trump wants these bills to go through, right? He wants the U.S. to lead in everything. He wants the U.S. to lead in technology and every area of technology, including banking. But the banks, they're quietly lobbying behind the scenes to kill this administrative bill, the Clarity Act. They don't want it. Trump certainly has his hands full right now with everything that's going on in the world, like right now, but he's still watching all this happen, and apparently he's had enough, right? So he went this week onto Truth Social, and he posted something that, well, most of what he does we've never seen from any sitting president, and certainly what he said here has never been said by any president, at least publicly. And he called out the banks directly. He said the Genius Act is being threatened and undermined by the banks, and that's unacceptable. He said that Americans should be earning more money on their money. He said that the banks are hitting record profits while trying to undermine the crypto agenda. And he said the banks should not be holding the Clarity Act hostage. And he named him. He called him out, right, on his public platform as president of the United States. Now, a lot of people, they read that and they think, oh yeah, whatever. Trump's just doing whatever Trump's doing, right? Political posturing. But the context matters here. Trump came into office wanting to make America the crypto capital of the world. He sees AI, he sees crypto as the next frontier of American economic leadership. And so he doesn't want to let the old guard, right, the technology adverse banks, hold the American people hostage over it. Now, the most powerful person on earth has publicly picked a fight with the bank, right? He's chosen his side. Now, to understand why the banks are on the other side, why are they willing to go to war with the president over a stablecoin bill? Well, you need to understand exactly what it is that they're protecting. Now, this is the part where Jefferson, like his warning, it starts to make sense. Right now, there's approximately $6.6 trillion sitting in customer deposits at U.S. banks. $6.6 trillion. That's your savings. That's your checking account. That's your emergency fund, and it's all parked at the bank. And what do they pay you for the privilege of holding your money? They pay you about 0.1%, maybe if you're lucky, 10 basis points. Meanwhile, at a minimum, the banks are making $200 billion a year on that same money, risk-free. They take your deposits and then they lend it back out at 6 or 7 or 8% on mortgages, on car loans, on credit cards, and then they pocket the whole difference. And then you earn nothing. Now, Jefferson called it out, right? He said the banks are depreciating your wealth slowly, quietly, every single year. Now, your bank tells you that, your money's available anytime, right? It's liquid. It's on demand. Anytime you can come withdraw it. Come withdraw it tomorrow if you want. But the reality is different, right? The second you deposit that money, the bank loans it out. Not for a week, not for a month, sometimes 15 years, 20 years, sometimes 30 years, right? That's your neighbor's mortgage. That's a commercial real estate loan. That's a, 7-year car loan. Your money has been deployed. It's not stored there at the bank. This is called fractional reserve banking. And it works as long as everyone doesn't ask for their money back at the same time. So here's the problem, right? The Clarity Act creates this problem for them where Americans suddenly have a legal, safe alternative that could pay them yield. That's the piece. Banks don't want to pay you anything, but if I can put my money into stablecoins and earn a yield, say 3.6% instead of the 0.1%, well then what are we going to do? We're going to start moving our money into stablecoins. And we're going to move all our money into stablecoins. And when we move all of our money over there, well, the banks don't have it. They can't just give it back. There is no money to hand back, right? It's all sitting in 30-year mortgages. It's in a mortgage in your friend's place in Phoenix, Arizona. If deposits leave at scale, well, the banks can't do anything about it, right? They can't liquidate those loans overnight to cover the withdrawals. That's what's called a bank run. It's existential, right? They're either forced to compete, I guess, by paying us the real yield. They could just do that, but that destroys their profit margin. Or they watch their deposits walk out the door, right? But neither of those options work for them. That's why they're going to war. That's why they're going to war over this. Not because they're going to make less profit, but because the math on enough exits doesn't end with a smaller business. It ends their business. Now, Jefferson saw this fragility, right? 200 years ago. He didn't just have a word for it yet. He didn't understand the mechanism, but he knew that.
The Bank Policy Institute, representing JP Morgan and Goldman Sachs, is deeply concerned. They aren't worried about consumer risk or economic stability. They are worried about their monopoly. For the first time since 1913, a crypto exchange can move money with the same institutional authority as a legacy bank. The crack in the wall is here, and it's getting wider every day.
Okay, so now that you understand what the banks are protecting, let's just take a look at the historical context for why this moment is so big and so significant. Because the money system, it's only been restructured twice in the last 100 years. This is the third time. Now, both times previously, the people who understood what was happening built generational wealth. The people who didn't, though, they got left behind. First time that we saw all this happen, restructured, was in 1913. That's when the bankers pressured Congress into creating, the Federal Reserve. And for the first time in American history, a central bank controlled the money supply. This was private banks. Private banks got the keys to the kingdom, right? They could now create money out of thin air. They could now set the price of money, set the rates. They could decide who gets access to capital. And the average American, they had no idea, right? They didn't know what happened. And honestly, most people still don't, right? If you care about that, I'd recommend reading the book called The Creature from Jekyll Island. And if you want me to go deeper on that, maybe make a video on it, you could drop a comment down below. Maybe I'll make a video on that. But the second time that we saw this restructured was in 1971. Then President Richard Nixon, he closed the gold window, right? Up until that point, every single dollar in your pocket or your bank was backed by actual gold. But of course, Nixon ended that overnight, right? So from that point on, money could be printed without any limit. Now, of course, the banks love that, right? Like when you can create unlimited money, well, the people who sit closest to the money supply, the printer, they win, right? That's called the Cantillon effect. But everybody else, the savers, the wage earners, and anybody that holds cash, well, they lose purchasing power every single year. Now, both times the money system changed, there was a window, a small window to get on the right side of it, maybe a short window. And most people missed it both times. And now here we are, 2026. I believe we're watching the third restructuring. All right. Now, this is not because of one tweet or, one post on True Social. It's not because of just one bill, but because for the first time since 1913, the infrastructure of money itself is being cracked open to competition, right? The banks have had this monopoly for over 100 years. And this very week, the walls all started coming down, and actually on two fronts, right? So the first, Trump joined the fight, right? We talked about that. But the second one that happened this week, I think it's even a bigger story. And I haven't really heard anybody talking about this.
We saw this with Larry Fink and BlackRock. In 2017, he called Bitcoin an index of money laundering. By late 2025, BlackRock was making $20 million a month in fees from their Bitcoin ETF. They didn't hate the asset. They just wanted to make sure they were the ones selling it to you. Last year, bank lobbying hit $87 million, the highest since the 2008 crisis. They are running the same playbook again, but this time, the President of the United States is standing in their way.
And that is that Kraken just became the first crypto company in history to get direct access to the Federal Reserve's payment system. Now, if you don't know, Kraken's one of the largest crypto exchanges in the world, and they were just granted what's called a Fed Master Account. Basically, what that means is that now Kraken can move money directly through the Federal Reserve's payment infrastructure. They don't need a bank intermediary, they don't need a correspondent bank, they have direct access. The same access that, until this week, only banks had. That means the monopoly on transactions, the thing that Jefferson warned us about, the thing banks have protected for over 100 years, just got its first real crack in it. And the bank, crack in it, Kraken, no pun intended, but the banks immediately have been losing their mind over this, right? We saw the Bank Policy Institute, which represents JP Morgan, Bank of America, Wells Fargo, Goldman Sachs. They said they were deeply concerned, quote unquote, deeply concerned. The independent community bankers said it posed, quote, risks to the banking system, end quote. Notice what they didn't say. They didn't say it poses risk to consumers. They didn't say it poses risk for the economy. They said it risks the banking system, right? Which is them basically telling you that the system that they're in, the system they have the monopoly on, that's what they're worried about. Not you and I, not our savings, not the economy, right? We actually have a real world example of what happens when you open payment infrastructure to non-banks. This isn't anything new, just new in the United States. Over in Europe, they've had it open. We can see the Bank of England did this in 2017. Today, there's over 300 non-bank institutions that operate in the UK payment system. And the payments over there, they got cheaper, they got faster, they got more competitive across the board, which is what happens when you have competition, which is, of course, great for consumers. It's terrible for banks collecting, fat fees on every single transaction. Now, the legislation is one front of this war. The infrastructure is being built simultaneously, and the banks can't lobby their way out of what already exists. Now that you sort of understand the stakes, right? You understand the historical context. Here's something that's going to reframe everything you've watched happen in crypto over the last 7 or 8 years. Now, the banks, they've been here before, right? Every single time cryptos threaten their monopoly, they've run the exact same playbook. Step one, scare the public, right? Get all the CEOs on TV, call it a fraud, call it, rat poison, call it a pyramid scheme, like whatever, right? Like make retail investors feel stupid for owning it, make them feel scared, right? And in 2017, Jamie Dimon called Bitcoin a fraud. Warren Buffett called it rat poison squared. Howard Marks called it a pyramid scheme, right? Step two, lobby Washington, right? Try to kill the legislation. Back in 2017, banks spent over $65 million lobbying to block a federal proposal that would have let crypto firms compete with traditional banks. And of course, the bill never made it to the vote. Bitcoin crashed from 20,000 all the way down to 3,000. Okay, step number 3, buy the dip. While retail's scared out of their positions and the price comes down, then the institutions quietly start to accumulate, all right? After that happens, step 4, repackage and sell it. Who do they sell it back to? To you. Put it in a shiny ETF wrapper, right? Charge a fee, call it a financial product. That's the playbook, right? And they've run it at least twice, and we can see it right here. Like, look, Larry Fink, he's the CEO of BlackRock, the largest asset manager in the world, over $10 trillion in assets. And he called Bitcoin an index of money laundering back in 2017. But in January of 2024, BlackRock launched a spot Bitcoin ETF. By late 2025, they were making $20 million a month in fees from that product alone. In 2 years, it became their most profitable ETF ever. Larry Fink, the same man, right? The same asset, Bitcoin, but a complete reversal. It happened the moment he figured out how to monetize it. So scare you out of it. They buy the dip, they repackage it and sell it to you. Now, look, he probably knew the whole time. They just wanted to make sure they were the ones selling it to you. And now last year, we can see the bank lobbying hit $87 million, a 12% jump, the highest level since 2008 when they were fighting off the post-crisis regulation. Now, that number tells you how threatened they feel right now. They're running the same playbook we see all the time, the same fear, the same lobbying, the same manufactured uncertainty. But the difference this time is that the president of the United States is actively working against them. All right. So that's the news. That's the context. That's the history. That's the underlying mechanism. That's the why behind this banking war that you see happening right now. But let's talk about what happens next, what happens from here. And more importantly, what should you and I be doing about this? How do we think about this? Now, we have a very recent roadmap for this. Last year, Congress passed the Genius Act. All right. This was the first federal stablecoin framework that went through. Now, what we saw is as the bill started advancing through Congress, Bitcoin ran from 74,000 to as high as 126,000. And that's not like a coincidence. When regulatory uncertainty clears, capital that's been sitting on the sideline, it starts coming in. It's been waiting for clarity, and so it comes in fast. And when the capital moves into Bitcoin, then it moves the price up. The Clarity Act, that's the next step, right? It's way bigger than the Genius Act because the Clarity Act doesn't just regulate stablecoins, it creates framework for the entire digital asset market. It legitimizes the entire ecosystem. And Section 404, the stablecoin yield provision, that starts pulling capital out of the banking system and into the crypto infrastructure. All right. So we have a documented recent example of exactly what happens when crypto regulation advances, and we can see the setup it's all forming right now. And look, I'm not going to tell you exactly when this passes or what Bitcoin's going to do, because obviously I don't know that. Nobody knows that. We could see more volatility before the breakout. I'm guessing that's probably what we'll see, right? That's the nature of this asset. But here's what we do know. The 1913 restructuring created generational wealth for the people who understood it. The 1971 restructuring did the same thing. Both times there was a window, and both times most people missed it, all right? And we're in that window right now. The banks are fighting this because they have to. Trump is pushing this because he has to. The infrastructure is being built because the market wants it, the market demands it. Now, when those three forces are moving in the same direction at the same time, that's not coincidence, that's momentum.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.